Okay, 11 o'clock. Let's get going. So I guess this week is Alex Wright from Fidelity Special Values. Just a couple of bits of news to look at first. NextEnergy Solar and then Schroder Income Growth. So NextEnergy Solar first. This chart is not great now. You can see the NAV is just sort of edging downwards, and so is the share price. Market cap still a decent size. The discount at 28.8 is narrower than it has been, but the yield is still enormous, 12.3%. And part of why I want to talk about it is clearly the high yield is not proving effective in encouraging investors to come in and narrow that discount down further. So here it says in the context of the sector as a whole. So nothing particularly remarkable on there apart from the size of that dividend. Second highest in the sector behind STCL Energy Income, the yield rather than dividend. And here is the performance table, and here you can see that the NAV returns have been slightly disappointing, especially the 10-year ones where it's kind of bottom of the list. Disappointing relative to the sector. Not absolutely, really. It could have done a little bit better, but it wasn't really intended to do much more than that sort of 7-8, I think. So, but obviously the share price returns have led down because of the discount widening, which hasn't helped. So it joins the long list of things that investors are putting a question mark over. This is the latest quarterly result. You can see here that the NAV fell again, down 2.3p. Most of that is down to reductions in power price forecasts, and we'll talk about those in a second. But obviously they are paying out a hefty dividend, and they're not doing enough to cover that at the moment in terms of NAV. But they are in terms of income. Now the power price forecast fall, they say reflects the external advisor looking at gas prices and saying there's so much new supply that gas prices are going to be lower, and so power prices are going to be lower over the next few years. And you can see quite a big drop from the grey line there to the blue one. And that's all fair enough. And we've also seen a sort of modest increase there in the longer term numbers. I spent quite a long time this morning checking against other European energy companies. These are not really out of line with what other people are saying. Now, one of the big things that's going to happen, we think, this summer, is that the government's finally going to pronounce what it's going to do about regional pricing. And it may be that they say, yes, regional pricing, we want to do it, in which case areas with lots of supply and not a huge amount of demand will have lower prices than places with lots of demand and lots of supply. So it's fortunate then, I think, for NextEnergy Solar that most of its production is in sort of central England, southern England, and there's a little bit in the east where I think prices might be lower, but we don't know yet how it's all going to be cut up, or even if this is going to happen at all. So, but I think if it does happen, they won't be too badly affected. And in any case, whatever happens to power prices, it's massively cushioned because they've got quite a lot of predictable income coming from subsidies, and also where they've got power price sales, they're selling those ahead, so they know what the revenues are going to be for this year and more or less for next year too, well in advance, and obviously they carry on doing that as this time goes on. There's no change to the discount rate used to calculate the NAV, so obviously they force cash flows out and then they discount that back, but the assets have a life of about 25 years. And so we do need to keep an eye on what sort of long-term gilt yields are doing, and they are still creeping up. And this is even though short-term rates are still coming down, as we said, we had the Bank of England rate cut the other day. That's unhelpful, but there's no compulsion at the moment to change the valuations. that's heavily informed by what you see in terms of sales of assets in the secondary market. Where NextEnergy has sold stuff, it's managed to get a premium to NAV for it. And there's been no other transactions that would say we need to have a sort of radical revaluation. Now, in terms of where we are with all of this, they are buying back stock. They are over halfway through now a £20 million buyback programme. That's put about 2.6% of its shares in Treasury. The gearing is creeping up, which is unhelpful because the NAV is coming down, and they think they do need to prioritise reducing that further. That does include the preference shares, though, which means it looks worse than it is. That's sort of less of a worry. They are still in this process of doing the capital recycling program that they announced quite a while ago now. There's still 100 megawatts of solar still for sale. They keep reiterating that there's no rush for this, but I think investors are getting frustrated. We should be looking at about another 50 million quid's worth of money to come in, so we'd like to see that happen soon. The dividend cover for the year that's just ended, so the year to the end of March 2025, was 1.1 times, and they've decided to maintain the dividend for the coming year at 8.43p. So maintaining the dividend rather than increasing it is sort of big news in the sector, because all the other things have been trying to march the dividends up. It looks as though, seeing they're saying the dividend cover target is sort of 1.1 to 1.3 times, that kind of implies that the operational cash flow they can see is going to rise, but they don't want to try to pay it out as dividend. I think this makes perfect sense, really. If you're not getting any credit for having a really high yield, then why bother marching the dividend up again? Instead, why don't you take some of that cash and use it to prioritise buybacks? And I think that is the sort of sensible thing to do. The chairman stepped down. Her only comment on the sort of big picture thing was to say that they regularly think about what to do about discount control, so that there's nothing radical there. But I think when we get to the results in June, they might have to say something a bit more concrete than that. That's NextEnergy. Schroder Income Growth. There's a chart there. The discount has been wide over the last sort of year and a half, and I think that really reflects its performance. And the 6-month numbers weren't great. It's held back by small and mid-cap exposure, which is a good excuse, really. Share price return was worse. The discount widened out again. They clearly needed to do something about that. This is from their fact sheet to the end of March, and you can see, so these are rolling 12-month periods to the end of March. It's a long time since they beat the index. We have to go back to the 12-month to the end of March 2021, and the long-term picture is not good, and that's a problem for it. And then if you look at it again in terms of the context of the sector as a whole, it's not very big, and its yield is not particularly high. That discount is relatively wide within that sector, which is part of the reason why they had to do something about that. And then the NAV returns are sort of not brilliant either. So I do think there were question marks about what should happen to this. So what they've done at the moment is they've decided to cut the fee. That's always a good thing. They're shifting it to the lower of market cap and NAV as kind of the base, and they reckon that will save about £300,000 a year. So tick, tick, tick as far as that goes, I think. They're going to, they appointed a new co-manager, all well and good. They're also going to use buybacks to try and target a single-digit discount. I don't think that's aggressive enough. People have said to me, even with that, you can see it sort of starting to disappear down the plug hole. I don't think that a fund that's fundamentally, I mean, most of it, I know it's got a buy small and mid cap, but most of it's big liquid stocks. I think it could have a lower discount than just slightly sub 10. And I think that means it's still vulnerable to attack by ARBs. So whether this one survives or not, I don't know. We've been saying that we need consolidation in the sector, in this part of the sector, for a while. We have seen some. I think it could be a target. So that's enough from me. I see there was one question about whether you think there'll be sector M&A in renewable energy, and I think yes, it's possible. I think we might see some consolidation within that sector, but that only really works if it also allows for some kind of cash exit at the same time. So how you structure that and who's the buyer is, that's the big question mark. Okay, let's bring in Alex. He's tapping away. There he is. Good morning. Thank you very much for doing this. Yeah, thank you very much for doing this. We're quite keen to hear about Fidelity Special Values, so I'm going to hand over to you and just let you run things. So tell us about the fund, please.
Fantastic. Well, yeah, no, thanks very much, everyone, for tuning in to listen to me. I'm going to talk for about sort of 15, 20 minutes about what we do on Fidelity Special Values, and then we're going to sort of open it up for questions. So taking it sort of right from the top, sort of me and Jonathan are the co-fund managers on the team. I've been at Fidelity now for 24 years, and Jonathan's been there 19. So we've been working together for a really long time. You can see initially on the smaller companies fund, just over sort of 12 years ago, and then more specifically on special values since sort of 2020. But also we have a really strong team at Fidelity helping us. So if you go on to the next slide, you can sort of see both the UK equity team. We still have a deep UK equity team with another 3 UK equity fund managers, which I would say is reasonably unusual nowadays, that we still have a very broad UK fund range, given obviously the difficulties of the UK market over the last 10 years. But also really importantly, we have a global network of analysts at Fidelity, a real waterfront coverage of stocks. So 132 analysts globally, of which 34 focus on pan-European and UK equities. And they are really invaluable in terms of helping us getting an edge on what's going on in the individual companies in the market. And it's been a very consistent team over the time that I've been running money over the last 15 years or so. And I think actually, when you think about the resources dedicated to UK equities, while we still have that really strong bench of people helping, increasingly competitors don't. And as a contrarian manager, looking for unloved things that other people aren't looking at, that's particularly exciting to me. And as you can sort of see on the next slide, when we think about sort of how does Special Values and its sister fund, the open-ended special situations, compared to competitors, you can see this classic Morningstar style box here on the right-hand side. We have a strong mid and small cap bias and then a value bias. And if you look at who else in these dots, which are the competitors in the UK, who else really looks at value, there's a surprisingly few funds that actually do, maybe only sort of 8 scaled competitors. And then you look at how much money is invested in that area. And I'd say 10 years ago, when we were reasonably new on the fund, that there was a reasonably small amount of people's assets in value. So only 10% of the sort of UK funds and only 2% of UK investors' total assets. If you fast forward to sort of end of last year, actually the amount of money that the average UK, or the total UK investors have, has increased dramatically. It's obviously sort of wealth creation and strong markets, but the absolute amount invested in UK value strategies has fallen quite dramatically. So sub £10 billion now, and that's less than 1% of UK investors' assets. So I think this strategy has always been contrarian, but it's increasingly contrarian to look at this space now. And obviously what you've seen is significant outflows from competitors, shutting down of a number of funds, retirement of competitors. And that means the edge that we get on the individual companies, I think, is actually increasing, which is really rare in today's investment world. Most areas are seeing more competition, more eyeballs, more information, and it's becoming much, much harder to outperform markets. That is not the case in what we're looking at. There's less people looking, less money invested, and therefore actually the chance that you can get an edge, I think, is increasing. And as you sort of see on the next slide, slide 6, this looks at the long-term history of the trust. So the trust's been going for over 30 years now. I'm the third manager on the trust after it was started by Anthony Bolton back in 1994. And I think what's really encouraging is over time, there's been a really strong absolute performance and a strong market beating performance. And you can see sort of the inception returns compared to sort of what they've been since I've been running the trust. And again, what's really encouraging is on an annual basis, just actually how similar they are. So the fund's given investors 11%, just over 11% per annum since I took over, compared to the 11.8% over the whole 30 years. The index performance has been, again, roughly similar. So UK index has been going up on a total shareholder return basis, including dividends, just over 7%. And so we have outperformed the market per annum by 3.8%. So not quite as strong as under Anthony's tenure. Clearly, he was feted, rightly so, as one of the sort of best fund managers of his generation, with that creating that since inception 4.7% outperformance. But we're very proud of the fact that we've been able to deliver a very significantly better number than the index. And again, I think this performance should be replicable going forwards because of the fact that there is that less competition than that there was 10 years ago. And the fact that actually the UK index has performed similarly over the last 12 years to the long 30 years, which again, I think is quite different from maybe some other markets, particularly the US, which have had a unusually strong performance over the last 10 years. And I would say it's probably stealing some of the future performance from investors with a big re-rating. UK market, as we'll show later on, is actually cheaper than its history. And therefore, most of the performance of the fund has actually just come from the earnings growth of the index and the fund over this period. So if we go on to look at sort of how do we do things on slide 7, this talks about what do we look for in companies. So forgive this for being quite sort of a wordy slide, but basically the two key things I want you to take out of this is we always think about how much of your money we could lose on every investment before we think about how much money we can make. So we always think about the downside as well as the upside on every individual stock. And so we do a lot of work on the risk to earnings. So what can happen to a company's profitability over the very long term through different economic and competitive cycles. We do a lot of balance sheet work to look at the financial risk of a company. So how much absolute debt is there? And we tend to steer clear of very highly indebted companies. But also think about holistically what are a company's obligations. So are there leases, pensions, off balance sheet, negative working capital? There's a lot of other things that can create financial risk, not just absolute debt. And then very importantly, we think about valuation. So just because you buy a good company with a good balance sheet, if you pay too much for that company, you can potentially also lose a lot of money. So it's a combination of all of those three that we look for in terms of sort of risks and downside to stock prices. Once we've done that work and we're happy we understand those risks and that they're quantifiable and limited, that's when we think about what could make this company, which today is valued cheaply, be worth more and be more attractive in the future. So we won't just buy cheap things because they're cheap. We actually want to think about what might make the future different. And this is the real legwork intensive part of the process where the Fidelity analyst team really come into their own. So it's about meeting companies. I, on average, meet probably 2 companies a day every day. So that's over 500 company meetings a year. Indeed, I already did one this morning ahead of this call. And it's about, first of all, hearing from management what's happening within a company. So internal change, potentially sort of new management coming in, fixing problems. Maybe there's been a spin-off or M&A. So again, spurs to internal change. Also do a lot of things and external change. So what's going on in an industry? So are there changes happening in industry level? Are competitors exiting? Where is demand and supply versus history in sort of long cycle industries? And we get particularly excited when there's a combination of the two happening within a company. So the more potential changes in the industry and at the company, the more exciting in terms of the chance of things coming off, because not everything then has to go right for there to be upside, but also the potential percentage change in the company's valuation as well, the more things that are changing. What that then results in is the next slide. Is a diversified portfolio. So we've got about 100 names in the trust in total today. Stage one, where we're buying a company, we've identified a cheap valuation, a potential for change. Stage two then is where the change we're hoping for starts to come through. And generally you see an improvement of the profits of the companies that we own and the excitement in the market about these companies. So you tend to see the companies outperform, and we allow these to become some of the biggest positions in the portfolios. Indeed, if you look at the likes of NatWest, Imperial, DCC, these will be some of the biggest positions in the portfolio today at about 3.5–4% of the portfolio. We do allow names to go up to a maximum sort of 5 or 6% of the fund. That tends to be where we start to trim ideas if they get bigger than that. And then stage three, this is where the change we're looking for has come through. These companies are now generally regarded as good companies. And there's nothing wrong here with these companies, but we look to recycle back into new stage one ideas where we think there's much more upside. It's very variable how long names may be in the portfolio. And I think that's well represented actually by the three in stage three today. Is Babcock has been in the portfolio for a long time, over I think 7 years for that change to come through, but it has come through and it's been a strong performer. Other stocks, Rolls-Royce and Direct Line, have been in much less. Both have been only in the portfolio for 2 or 3 years. Turnaround, I think, has been recognised quite quickly at Rolls, and the stock's done exceptionally well, probably much better than we thought. It would have been better for us to have a bigger position in that. And then Direct Line, a competitor, has recognised the change we were looking for and has paid up for that sort of earlier than maybe you would see it coming through, by looking to take over the business. And again, that has been something that's been a feature of the fund, that clearly if we're buying good franchises, but they're cheap, other people might recognize that and bid for those companies. And you can sort of see SMS as well is another stock that we sold not that long ago that was recognized as value by a competitor and taken out. And we've had some others in the fund. Most recently today, we've got H&T that's recently received a takeover bid. Actually, that's an unusual one. That's been in the fund for 10 years and was actually trading on a total shareholder return basis an all-time high before they then received a bid at a 45% premium. So that's actually somewhat unusual that the stock overall, we probably made about 500% in that over that 10-year unusually long holding period, whereas on average the holding period is probably more like 3 to 5 years. If we then go on to the next slide, this sort of shows sort of where overall we're finding value, and we've categorized the UK market into sort of 4 super sectors. So sort of financials, which are a big part of the UK market, and indeed we've had a high holding in over time and still do in the banks and the insurers, but actually at the margin we've been taking some profit there as some of the banks have done particularly well. And on the flip side, we've actually been buying into some more other GDP sensitives whose weights moved up more recently, as we've seen more value there. Defensives are about in line with the market now, again, of having taken some profit from the likes of Imperial. Resources has been the one area really where we've been pretty consistently underweight. I've generally found it difficult to find value in mining. We have bought a little bit of that recently. We added a small position in Glencore. We have some gold miners, but then we're also today very underweight oil. So while in the past we have found quite a lot of value in oil, particularly at times when the oil price is very low, So like 2015 and 2020, when Shell was a really big position. But as it stands, we don't own either of Shell or BP, which are big names in obviously the UK market and widely owned by other investors today. Slide 10 then digs a little bit more into some of those transactions over the last year that we talked about a bit. So I think in terms of sort of trends, you can see, the number of sort of oil sales, so selling out of likes of Shell and OMV, which were successful investments. Ithaca was an unsuccessful investment, reinvesting a bit of that in Total, but overall quite small, sort of 3 or 4% position in oil. Reducing some of the banks, so particularly AIB and Barclays that have done particularly well. We've totally sold out of Barclays now, but still have big weights in banks overall, Standard Chartered and NatWest being the biggest two positions. Selling out of Ericsson recently, that was a successful investment. Obviously, Ericsson is a non-UK company, and we have the ability to invest up to 20% overseas. We're using about 10, 11% of that today, particularly in Ireland. So the likes of AIB, two Irish house builders, and also Ryanair. And then in terms of those additions, we've talked a bit about that sort of adding cyclicals. The cyclicals that we've added are primarily sort of UK domestics. So that's an area that's been quite out of favour since interest rates started to rise in mid-22, and indeed there's been an area where we've been reasonably underweight, which was good because performance of those stocks have been pretty poor through 22 and 23. But throughout 24 and indeed more recently, we have been adding back because a lot of areas are now really depressed. So house building volumes are 20% below what we saw in 2019. That has a kick-on effect in terms of sort of sofa sales are about 25% in volume terms below 2019, kitchen sales 20% below. And so actually there's a lot of industries that are operating on quite depressed volumes where there's also been some exit of competitors. And therefore that's something that's quite exciting for me, sort of an industry, there's the potential for volumes to rebound and for market shares to stay at higher levels going forward because of that exit of competition. And that's very much the case in kitchens. So we've bought into Howden, where Nobia, who trade with the Magnet brand, have been closing showrooms. Genuit, business used to be called Polypipe, which does supplies to new house building. And also Fraser's Group has been a big new purchase. That's coming up for a 2% position in the fund. They used to be called Sports Direct, so a more general UK retailer, where they've taken a lot of market share over time and indeed have stakes in a number of other businesses which have been struggling as well. So I think that's quite an interesting story, albeit a complicated story, and one with unusual corporate governance, which again is a reason why other investors maybe don't do the work, steer clear, whereas this is a company, this is the third time we've owned it actually, and we made money on it both times before, and indeed actually the stock has rallied very strongly since purchase as well recently. So still in the fund, but obviously now the third time that we've made money on that unusual position. If we then go to slide 11, this talks about gearing in the trust. So like other investment trusts, Special Values has the ability to borrow money to buy stocks, as does my open-ended fund, Fidelity Special Situations. I think it's much more unusual for a open-ended fund to gear, but both portfolios have the ability to do so. Also, as you can see, this line is very variable. So you can sort of see we don't have any bank debt. We only have very flexible CFD debt, and that means we only pay for the debt when we use it, and we cash settle that the CFDs every day. So it's super efficient and very cheap debt. You only pay about 0.4% over overnight rates. It was a typical bank loan, you'd pay over a 1% margin compared to overnight rates. So it's much cheaper and much more flexible form of debt, which has been very attractive for the fund over time, particularly as when you look at when gearing levels get very high, it tends to be when markets have sold off because there's many more positions there. And so you can see that the maximum level of gearing we ever got to was all the way back in sort of October 2020, pretty much the day before they discovered the COVID vaccine. And so that was a great time to be at sort of maximum leverage, because then the market subsequently performed very well. And you can see that subsequently from there that the gearing has tended to sort of drift downwards. If we then have a look at sort of where we're investing on slide 12, this shows sort of how different special values the investment trust is compared to the market. So UK market has over 80% of the stocks in large cap above 5 billion, whereas we only have about 40% of the portfolio there. And there's many more sort of mid and small caps in the fund. And I think that particularly pays to the strength of sort of our investment style, that we're looking for these uncovered gems. You're much more likely to find those down the market cap spectrum where there isn't the coverage and other people looking. And then also you've just got far more choice. There's probably about 1,000 investable companies in the UK market above 100 million, which is pretty much where we go down to. Whereas obviously above 5 billion, you're talking quite a concentrated market, so some sort of 50 companies there. So again, the chance that you find something unloved is much reduced in the larger cap part of the market, because there's that much less choice. So the next section then just talks about sort of the outlook for the fund and the UK market. And I think this is quite a powerful slide in terms of the UK market continues to be really unloved. And you can see the right-hand side, these are sort of outflows from the UK company space. So pretty fairly consistent since sort of 2021, after there being sort of some inflows, some outflows prior to that. Which to me is really surprising, because while the UK market did have a horrible period of performance from 2016 to 2020, you can see this 40% underperformance of global markets. That was now over 5 years ago. And actually the last 5 years, obviously with some volatility, but largely UK markets have performed in line with global markets. So I'd say, well, there was something very wrong with UK performance from sort of 2015 to 2020. There hasn't been anything wrong with it since then. And it's been that period where investors have withdrawn money, which I think is irrational, because the UK market has some really great opportunities today. And indeed, if you look at the performance of the trust on slide 15, you can sort of see actually how well has special values performed, not just versus the all share, but actually we've beaten the NASDAQ over the last 5 years. So a lot of investors have been pulling money out and putting money into the US, because obviously on a 15-year view that the US has done better. But actually that is a mistake over the last 5 years, because we've been able to perform better than the NASDAQ in the trust. And again, very few people sort of really realize that. And so a lot of people sort of say, what needs to change? What's going to make the UK market more attractive? For me, I don't want anything to change. I'm super happy with how things have gone over the last 5 years. Performance has been good. The trust is at all-time high. Our returns for investors are good and are in line with the long-term averages, consistently beating the market. We don't need anything to change. Now, that said, if you look at slide 16, the performance of the trust and the UK market hasn't been because this big valuation gap that everyone talks about has actually closed. So on a sector adjusted basis, so effectively adjusting for the fact technology is so big in global markets, you can see how cheap the UK market looks. So still at a 25% discount compared to global markets, whereas the historic discount's more like sort of 10 to 15%. And that gap hasn't been closing. So why has the UK market performed in line with global markets despite that valuation actually further opening up over the last 5 years? It's because earnings have been better in the UK than they've been globally. So this isn't about sort of earnings growth being better globally. Earnings growth hasn't been better than the UK market over the last 5 years. And then if you look at absolute valuations, you can see UK absolutely looks very attractive. So forward earnings sort of about 11 and a bit times. This data is from February, so markets have obviously rallied a little bit from there, but I think still absolutely cheap. And that compares very favorably to other global markets on sort of 13 to 14, and obviously particularly well to US markets, which are still on sort of 20 times forward earnings. So I think, yes, the UK has been performing decently, but actually from this valuation, there's every potential for it continue to perform decently. Whereas I'd single out the US at that kind of valuation. It's much harder to make positive returns from that level of valuation. If you just compare the UK to its own history, this looks at sort of what has the average P for the market been over time. So it's been about 14, and you can see the UK market at just under 12 times as of the end of April. In terms of the larger caps, as you go down the market cap spectrum, whereas historically largely mid and small caps have traded at that same sort of 14 times, actually there's a bigger discount. So mid caps are more like 10 times earnings, actually small caps are more like 9 times earnings. So you're getting more and more of a discount the more you go down the market cap spectrum. And certainly at the margin, that's something we've been doing. So selling out of some of the larger caps that have done well, like a Barclays, trimming Imperial, and investing in more of these mid and small caps like the DFSs and the Frasers in the fund. If we then look at the next slide 18, this compares the fund to the market. So you can see that while the market itself is reasonably cheap and sort of 12 or 13 times forward earnings, you can see that the fund is on 10 times forward earnings. So at a discount to what already is a cheap market. But also what's encouragingly, it is that you can sort of see what's the earnings growth of the fund. So these again are estimates, but we're expecting sort of strong earnings growth from the fund. So sort of 8.5% this year, 11% in 2026, compared to the UK market as a whole, where there's much lower earnings growth. So actually, we expect earnings to go slightly backwards for the UK market in 25 before sort of rebounding in 26 and 27. Now, a lot of the market level earnings contraction is actually down to the big oil companies, or as the oil price is down year on year. Also, commodity prices in other industries are down too. And then obviously the US dollar, which had been strong, has weakened, and a lot of larger cap UK companies actually earn their pound earnings in dollars. So they have big exposures to the US market, likes of a sort of a Diageo or a Unilever would have very big dollar earnings. And overall, actually, as a fund, we have much more pound earnings than we do dollars, which is actually not the case for the market as a whole. So I'm going to sort of stop there. That's the end of the sort of formal presentation, which I think should give everyone sort of 20 minutes to ask questions.
Brilliant. Thank you very much, Alex. We've got some questions already, but please do keep putting them in. So start off with, can you tell us what the differences or the similarities are between this fund and the open-ended fund, please?
So to be honest, both funds are extremely similar. But I suppose the big difference is slide 12 in terms of this. Both funds have strong exposure to mid and small caps, but it's that much larger in special values. So particularly in those more micro cap, sub £200 million companies, there's hardly any of those in special situations, whereas they make up sort of 5 or 6% of the fund. In special values. And so, yeah, the fund's 95% the same, about sort of 5% difference. And as you can see from the previous slide, that's largely by having a slightly higher gearing level in special values than special situations on average.
Yeah, okay, that makes sense. Cool. So within the sort of big picture for the UK market, are there sectors that you just wouldn't touch at the moment?
So on average, I try and look at everything. So across all sectors in the UK. Now, there's types of stocks that I would avoid. So clearly, because I'm always looking for sort of downside protection, we wouldn't buy sort of very speculative stocks. So say sort of exploration companies that don't have any oil production, or biotech companies that are looking for a new drug but don't have any base business. But to be honest, that those are quite small sectors in the UK, and actually over the last 10 years become even sort of smaller sectors, because on average those companies have actually done quite poorly. Otherwise, we're happy to look at absolutely everything. As you can see from the super sectors on slide 9, the fund has had a real preference for financials over time, because I think ever since the global financial crisis, this has been a sector that some investors have avoided totally, and therefore there's been sort of less people willing to look. And to be honest, these are complicated businesses. So without the help of our dedicated sort of life insurance analyst, who's been an analyst on that sector his entire career, or our UK banks analysts, we would struggle to sort of be on top of those companies. But because of that Fidelity research team, I'm really confident in the investments that we've got there across multiple different areas. So we are quite diversified within financials, having lots of different types of businesses that play to different geographies. So obviously Standard Chartered would be UK quoted, but almost all of their operations are in Asia. And again, feeding into our Hong Kong and Sydney-based research teams, Singapore-based team is really helpful for stocks like that.
What triggers the use of the ability to use overseas companies? Why would you go and buy one of those rather than make it all UK?
Yeah, so again, I think the fact that we have that big global analyst resource really helps with the ability for me to sort of buy some of these companies. And we particularly do so in some of the bigger sectors where companies may have very similar geographic exposure but be quoted differently. So if you look at some of the big holdings historically, we've owned quite a lot of Roche and Sanofi that largely have similar businesses to a Glaxo and a Astra, but at times have been at better valuations. Actually today our healthcare holding, the biggest is Astra, but it's a reasonably small holding, and we've sold out of Sanofi and have a small position in Roche. Similarly, in sort of Total, I think Total is a better returning business and also a cheaper business than BP or Shell, and clearly has a very similar business model. I'd say the sort of one exception to that is probably the Irish exposure, which is big in terms of we sort of treat Ireland as another domestic market. So while we don't really have a view on what's going on in France or Switzerland, like locally, but you don't really need to for owning Total or Roche, where clearly when you own an Irish house builder, you need to be on top of Irish planning, Irish construction markets, what's going on in the banking system. And so with Ireland, we do that. We make an effort to regularly go over to Ireland, probably done so sort of once a year on average over the last 10 years. And so we have had more domestic investments there.
Cool, thank you. What triggers a sale? So you've talked about some of the trades you've been doing recently. So what are there, other than a bid, obviously, what would make you sell something?
Yeah, so there's sort of two reasons for a sale. So if you look at sort of slide 10 is probably a good one to sort of talk through. So obviously the best one is the stock does what you hope. It's sort of delivered the returns you expected, the profitability you expected, and you sell out for new ideas. So a Barclays and Ericsson would be great examples of that. On the flip side, the other reason for selling is that your original thesis hasn't worked out. So what you thought was going to happen, and we make sure so that we're unemotional about this. We always write down on a master spreadsheet why we're investing, what we think could happen, why we think it might happen. If we decide that actually the fundamentals are played out in a way that suggests we're wrong, we'll look to sell out. So Ithaca would be an example of that. We were both surprised by the degree which investment allowances were removed by the previous government, but then also we were very disappointed by the performance of the underlying oil fields as well. That the performance and cash flow out of those was very differential from what we were expecting.
Well, that makes sense. So do you have a sort of price target in mind when you buy something? Is that the way you're doing it, or are you looking at relative to where it used to trade?
Yeah, so we put an upside and a downside price target on absolutely everything that we invest in that master spreadsheet. Um, and again, I think it's really important to do that, to sort of think about what you think a company can earn in the medium time. So sort of 3 to 5 year view. So not a short term view, but a medium term view. And then what you think the market should pay for that. And I think you do that up front, generally when the company's unloved, means that you're much less likely to sort of fall in love with a company just because it's doing well. Just because a company's doing well doesn't mean that the multiple you should pay for it is higher. Now, we are flexible with those price targets because obviously it's very difficult to forecast out, particularly when you're thinking about 3 to 5 years. So you may well be very wrong with actually the company's earnings ability. And if a company's earnings ability turns out to be higher than you expect, you will pay a higher target price. What I find it's really important to do is not change the multiple you're willing to pay. And that's when we start to sort of trade down once we've reached that target price based on that multiple. And we tend to sell gradually. So again, the market, I found, if things are doing well, tends to get a bit overexcited about what a company is worth. And therefore we're okay to sort of capture some of that as we're selling out, but clearly it's a much more dangerous game when you're holding a company for what you perceive as above fair value. So that's why we reduce the position size when we get to those target prices.
Mm-hmm. And then what can you sort of tell us how the position sizes are determined initially when you're going into something? Will you just buy a small bit, or are you actually sort of quite punchy from the get go?
Yeah, so slide 8 sort of shows the positions, and we generally start small as we're getting conviction, because if you think about it, we're meeting the company, we're establishing a thesis. That will be when the company's cheapest, but also where we're most uncertain about the future. And then we're looking to use the analyst team to really do due diligence around a change. So meeting with the competitors, meeting with the suppliers, doing expert calls with private companies to really see, does that thesis stack up? And as it does, we tend to sort of buy gradually more of the company. But it's a very iterative process in terms of sometimes you know a company in an industry quite well, and therefore it's quite easy to get that work. So you do buy quicker. So Frasers it's a company we've owned twice before. We know the industry well. We cover the retailers, and so we have good access to what they're saying. So we built that position up very quickly over a couple of months. Whereas other times you will take longer because it might be harder to get the due diligence. And also sometimes the due diligence doesn't all come back positive. So again, you generally expect a mix. And so again, we tend to have a smaller position in a company where there's a mix than if it's all coming back positive. If it all comes back negative, we obviously will look to sell the position. So just because something's cheap, but actually the turnaround doesn't sound like it's going to come through, we won't buy something just because it's cheap. There needs to be the potential for positive change.
That all makes sense, thank you. BAT, I'm intrigued by. Big company, obviously, not much has really changed in the story, I would have thought. Why is it attractive now?
Yeah, so we bought Imperial back in 2019 because Imperial had a very poor 5 year period, because they'd been losing a lot of market share, and in fact the management team was reasonably ineffective in marketing both the core business, but also particularly in the next generation portfolio. And there was a change in management team that we thought had the ability to reinvigorate both sides of the business. And indeed, that very much has come through in terms of Imperial was losing market share in their core markets. They're now gaining market share, and they are now growing the next generation business, albeit next generation is quite small still. So I would say actually their success in terms of growth rates on that has probably been a bit disappointing compared to what they've done on the core business, and particularly compared to the performance of the company. So we've seen about 170% total return from Imperial since 2019, And so it is largely doing what we hoped, and we've started to trim it down. As we have been trimming it, we've been buying some BAT recently because a somewhat similar thing has happened. So while I wouldn't say BAT has misfired in all of their major markets, which it was the case for Imperial, that they definitely misfired in the US. So the US, they were losing market share, actually, to Imperial and other low-end players, that they weren't effective enough in terms of their market. So again, it's an unusual business. You can't market above the line, you can't advertise, but you can certainly spend a lot of time with sales reps and stores and the distribution, and they were misfiring there. And again, you had a new CEO come in, a new head of the US. They put more investment into the US. They've been a bit more careful about the percentage price rises they've been taking there, and that's all helping with market share. But the thing that really excites me about BAT, and which is changing at the margin now, is the regulation of next generation product. So next generation is much bigger for BAT than it is for Imperial. It's about 20% of turnover compared to 5%. And particularly in the US, they have a big vaping business where they have about 45% market share. So really quite dominant in the legal vaping market in the US. But that business hasn't been doing very well because actually 80% of the market in the US is illegal. So this is disposable vapes, primarily Chinese produced, where flavors are very dominant. And crazy flavors like watermelon, unicorn, stuff that clearly is designed to appeal to kids. And so to me, that 80% of the market, and it's not a small market, we're talking $5 billion plus sales of that product, the US authorities are going to crack down on that. But it's only a matter of time. Now, I've been very surprised the degree of lack of crackdown, except on a sort of state-by-state basis. But also, particularly with the de minimis rule on Chinese imports and the tariffs, that this is a real chance to sort of get this product out of the market. And it is product that really should be out of the market because it doesn't have to, well, because it's illegal, it doesn't qualify. There's no product testing, there's no quality control, there's no restriction on crazy flavors that appeal to kids. And so if that market goes away, BAT have a chance to capture an awful lot of this market, given their dominant market share in vaping. And that could be a big kick to revenues in what is a much more highly valued part of the business, because clearly, and rightfully so, volumes globally in tobacco, because it's an incredibly harmful product, are going down quickly. But next generation is growing. The global nicotine market is growing. And BAT are only paying about sort of 8 times earnings. Whereas if you look at a player who's more advanced in next gen, like Philip Morris, which is quoted in the US, that business has more like 45% of its earnings from next gen. So still majority from tobacco, and that's trading over 20 times earnings. So if we see genuine growth and profitability coming out of next gen, that can be very transformational for the valuation of BAT.
Brilliant. That was great. Thank you. One more on here, M&S. Did you get out of it before the recent problems? And given the recent problems, would you get back into it now?
Yeah, so actually M&S we sold over a year ago. So actually probably at a share price below where it is currently. And again, that wouldn't be that unusual. We tend to buy in early and probably get out a bit early. And so again, that's another reason for the sort of the gradual selling. I think as well, M&S have done a great job on the food side, which was very much our view that when they did the Ocado transaction, people thought that was a terrible transaction. I thought that was a masterstroke, not because for the online business, but actually for the purchasing power it gave to the core food business, allowed them to become far more price competitive because the purchasing massively increased, and allowed them to increase what was a very low market share. So M&S have always had a great food offer, but it's always been expensive, and therefore it's been very limited market share. Being able to sort of lower the average price has allowed them to really ramp up the market share in the food business. And then they have also benefited by the exit of a number of sort of clothing competitors as well through sort of COVID. So sort of Debenhams, New Look, and lots of Topshop, etc. All sort of core sort of M&S competitors have all disappeared. I'd say that side of the business, though, while it's doing fine now, is still tricky because M&S still do have a lot of legacy space where effectively the stores are not really where they should be. They're all sort of still in town centres. They don't have nearby parking. They're old buildings that aren't really keyed up for sort of modern retail. And so I do think that's something they've been working on for a long time, but because of the nature of their leases and the structure of these stores, it's still hard. And so once I sort of saw the food sort of turnaround priced in, that was something that sort of made me want to sort of sell out. And I think the stock isn't expensive, but I think the upside, given that the clothing business still has some of those structural issues, I prefer to sort of buy other retailers, sort of like a Frasers or things that plays to housing like DFS or Genuine.
One more that isn't on this slide, but is in the questions here. Chris Nicholson. Is that one you've been buying?
Yeah, so again, Chris Nicholson, you can see on slide 10, is something that we bought in the first quarter of last year. It's a reasonably small position, again, because it's quite a small company. So it's about a sort of 0.75% position. We've tended to be more into volumes of house building, given that the volumes are clearly depressed. So 20% below the level of building in 22, which is again about 20% below it was in 2019. So particularly with the positive changes we are seeing on planning and it becoming easier to build houses, we definitely think volumes are going to pick up. Now, at the margin, that is positive house builders too, but the key driver for house builders is are house prices going to go up? And obviously, house prices are actually pretty similar to what they were in sort of 22. You haven't really seen a correction in house prices. So I think for Chris Nicholson, which is very cheap versus peers, and admittedly has had some specific issues, that there is an interesting story. But I think for house builders as a whole, it requires positive house price inflation, which I think is a much harder call. That will require interest rates to continue to fall from here, which may well happen. But again, I don't tend to try and take a strong view on what interest rates are going to be.
Great, thank you. I think we better sort of wrap it up here because we're running out of time. But thanks very much. We've covered a lot of ground. And good luck with it all. And we will get you back in a year or so.
Brilliant.
Thanks for your time today.
Thanks very much for having me on, James. And thanks everyone for giving me the chance to present.
Great. So we have a few appendices to go through, which you'll be able to freeze frame and have a look at. Don't forget the very important disclaimer slide and Fidelity's. And then we'll be back next week and I'll be talking to Alan Gould from Patcher Private Equity. So have a good weekend and we will see you next Friday. Thank you.
That's great. We're off live now. Thank you, everyone. Thank you. Bye-bye.